Welcome to our module on Cost Accounting Basics, where we'll explore fundamental principles that every business uses. Here, we will learn how businesses effectively track, analyze, and manage all their various expenses for better decision-making. Let's begin by classifying costs based on their nature and how they behave in different scenarios. Understanding these core characteristics of costs is crucial for effective financial management and analysis. First, we have direct costs, which are expenses directly attributable to a specific product or service. These are costs that can be clearly and easily traced to the production of a particular item or service. For instance, the wages paid directly to workers assembling a car are a perfect example of a direct cost. Next, indirect costs are expenses that cannot be directly traced and are often allocated across multiple products. These costs are not directly linked to a single product, but are necessary for overall operations. Examples include factory rent or general utility bills, which support the entire production facility. Moving on to fixed costs, these are expenses that remain constant, irrespective of the production volume. Whether you produce a lot or a little, these costs do not change within a relevant range. A clear example is the monthly rent you pay for your factory, which stays the same. Finally, variable costs change in direct proportion to the level of production or activity. These costs increase as production increases and decrease as production falls. The cost of raw materials used per unit produced is an excellent illustration of a variable cost. Now, let's explore cost classification based on their function within the business and the period they relate to. This helps us understand how different costs contribute to operations and are accounted for over time. When classifying by function, we first consider manufacturing costs, directly tied to producing goods. These include all expenses like materials, labor, and overhead that go into making a product. Then, non-manufacturing costs cover expenses related to selling products and managing the administrative side of the business. For example, sales salaries or office rent fall under non-manufacturing costs, supporting sales and general operations. Combining behavior and function, we categorize product costs, which are included in inventory. These costs are expensed only when the products are actually sold, becoming part of the cost of goods sold. Period costs, on the other hand, are expensed in the accounting period they are incurred. Examples include office supplies and executive salaries, which are recognized as expenses immediately. Let's dive deeper into understanding cost behavior and how various costs respond to changes in activity levels. This insight is vital for forecasting and managing expenses effectively as business activity fluctuates. Fixed costs remain constant in total, staying the same within a relevant range of activity. Variable costs, however, change in direct proportion to the level of activity or production. Mixed costs are fascinating because they contain both a fixed and a variable component within them. Finally, step costs are fixed over a specific range of activity, then jump to a new fixed level. Now, let's introduce a powerful analytical tool: Cost Volume Profit, or CVP analysis. CVP analysis helps us understand the crucial relationships between costs, sales volume, and the resulting profits. Let's explore the key concepts of CVP analysis, which are essential metrics for effective profit planning. These concepts provide the foundation for understanding how changes in sales and costs impact profitability. First, we have the contribution margin, which is the amount remaining from sales after covering variable costs. This remaining amount directly contributes to covering your fixed costs and ultimately generating profit. The formula for contribution margin is simply sales revenue minus all your variable costs. You can also express it as a ratio: contribution margin divided by your total sales revenue. Next, the break-even point is the level of sales where your total revenues exactly equal your total costs. At this crucial point, the business achieves neither a profit nor incurs any loss. To calculate the break-even point in units, divide fixed costs by the contribution margin per unit. For the break-even point in rupees, divide fixed costs by the contribution margin ratio. Today, we'll explore two crucial concepts: the margin of safety and target profit, essential for financial planning. Margin of safety shows how much sales can drop before break-even, while target profit calculates sales needed for desired profit. Both are vital. Let's dive into understanding job costing, a crucial method for tracking expenses in unique projects. Job costing specifically helps in tracking and accumulating costs for distinct, one-of-a-kind projects. It focuses on individual jobs, where costs are gathered for specific, customized customer orders. For each job, costs are carefully accumulated for specific, customized customer orders or unique projects. A job cost sheet is used to track direct materials, direct labor, and allocated overhead. This essential document meticulously tracks direct materials, direct labor, and overhead allocated to each specific job. To calculate the total job cost, we add direct materials, direct labor, and allocated overhead. The job cost is simply the sum of direct materials, direct labor, and allocated overhead. Now, let's explore process costing, a method for allocating costs in continuous production. Process costing is specifically designed for allocating costs efficiently in environments with continuous production flows. This method is ideal when homogeneous products are made in a steady, continuous production flow. It's applied when identical products are manufactured in a consistent, ongoing production process. Costs are accumulated by department or process, then spread evenly across all units produced. Here, costs are gathered by department or process, and then distributed uniformly across all produced units. Equivalent units measure how costs are allocated between completed and partially finished units. These measures are crucial for correctly allocating costs between fully completed and partially finished units. Let's compare job costing versus process costing to understand when to use each method. Choosing the correct costing method is vital for accurate financial reporting and decision-making. Job costing is best suited for customized, distinct products or services, like a custom-built house. It is specifically used for unique, distinct products or services tailored to individual customer needs. With job costing, expenses are meticulously tracked and assigned to each individual job or project. Common industries include construction, consulting, and custom manufacturing, where each output is unique. Process costing, on the other hand, is ideal for continuous, homogeneous production environments. This method is applied to continuous, uniform production, where identical units are mass-produced. Here, costs are accumulated by the production process or department, not by individual units. Industries like food processing, textiles, and chemicals typically use process costing due to their continuous output. Let's recap the key takeaways from our discussion on cost accounting basics. These are the essential points to remember for a solid understanding of cost accounting. Remember, classifying costs properly helps businesses manage their expenses much more effectively. Understanding cost behavior helps predict how expenses change with varying production levels. CVP analysis is a powerful tool for budgeting, accurate forecasting, and informed decision-making. The contribution margin and break-even point are fundamental metrics in CVP analysis. Job costing is perfect for unique projects requiring specific and detailed cost tracking. Finally, process costing is applied to continuous production of identical, homogeneous goods.